Welcome to this week's subject on tax planning. We are glad you're here. I'm going to give everybody a couple minutes to get in here, then we'll get started right on time. So if you're just funneling in, again, welcome. We are glad to have you here. Going to have a great discussion on tax planning. Hopefully it will keep you engaged. It's definitely not beginner stuff, but you will have the recording. If you need to watch another part over again afterwards, feel free. As per normal, throw your questions in as we go. This one is going to be so jam-packed, though, full of information and examples that we are going to be challenged on questions, but I'm going to try. You're going to see me talking fast. I may have to skip a few of the examples because I put so much in here. So hopefully you'll appreciate this. This is not just a slide presentation like you'll see a lot of tax practitioners and CPAs and tax attorneys, et cetera, put together. This is going to be a very practical, hands-on, digging through things. So bear with me. Everything is going to be live in terms of the software that we're using, the case studies, et cetera. And so knock on wood, everything's going to go super smooth. But if there are a couple hiccups, just bear with me on it. Again, throw your questions in the chat if you have them, and I'll try to hit them as we go. So we will go ahead and get started. We are right at the top of the hour. And so, or bottom, however you want to look at it, we always start off with a bottom line up front. And so a bottom line up front on something like this is a little bit more open-ended. But I think you're going to be able to take away from this a better understanding of where our tax system is as a whole, a little bit of its history, to understand a little bit where it's going so that you can make better decisions. And then as we jump into the nitty-gritty of all the things in the different scenarios, about how much potential that there is, and that it is very individualized based on where you are in your life, what you want to do, what your situation is, and where you're going, and the assumptions that you make about the future, because taxes could change a lot. This is something that's been pretty static until the last 15 or 20 years. Not much tax change in the previous 40 or 50. So this is a big difference. Okay, so Dylan posted up there. Hopefully everybody got their audio on. Let's go ahead and go into the presentation. So the first part is going to be a little bit slower, but it's super interesting. We're going to go over the tax system and where things are now so that you have an understanding, or at least a base understanding where things in. I'm not, obviously the tax code's super long. So, just kind of looking, of course, income tax hasn't been around the whole time. I mean, that's front and center of the debate these days with all the tariffs and, why do we get rid of them? Why do we go to an income tax, et cetera? We needed money. That's where the money was. And of course, we got involved in a couple wars, which were very expensive to us. And we had to have a better stream of revenue that didn't necessarily cause recessions and worsen depressions, et cetera. And so you could see the highest rate up here was way high and the lowest rate was way low, right? It's a very progressive system. Of course, in between the wars, it went back down and then up and stayed up for a long time. And of course, from the end of World War II until the Reagan era, arguably was one of the best times in American history for progress, the growth of the middle class, et cetera. We got these tax cuts here, you can see, which were predominantly for the upper, not really any for the lower. And then we got a lot of benefit from the run up of the 90s, and then a lot of malaise and boom and bust in between here, but arguably a huge amount of wealth accumulation and breaks on the upper side of things. When you look at us globally, okay, so versus other countries here, you can kind of see, we are below the average for all countries, basically. And on the lower side of things, most of the countries we probably see as the ones we admire for higher standard of living, and you'd like to go there even though you may not like to pay their taxes, are more on this side. We're on this. It's interesting. I think just yesterday I saw a Wall Street Journal article that was talking about the United States is actually becoming a tax haven. right? That's so backwards from, I think, what we've thought in the past. And we look at like how much are we paying versus the average, and we're way on the low side down here with Mexico and Korea and Ireland. And so when you look at us historically and versus other developed nations, the main thing you should take away from here is that we're low, right? And so for people that are like thinking about the future of, do I think that I'm going to pay more taxes now or in the future? I mean, you look at this compared with the next thing we're going to look at is how our deficits have blossomed over the last 20 years and how the debt is just going up. I mean, it's a pretty clear picture that taxes will be higher in the future. Now, tax on what? We don't know. And so obviously you can see here, we are kind of, steadily running deficits. We had some surplus here at the end of, Clinton. And then, of course, we ate that away. And then, of course, 2008, 2009, we spent probably, we don't know, but probably stop a recession from turning into a depression. So maybe not bad spending, but it would have been nice if we could have got back to where we were. But of course, it looks like we tried. And then, of course, COVID, and now we've almost given up in terms of spending. And I think this year is going to shape up to be one of the bigger ones ever in history as well, too. So take that with a grain of salt. So what's our debt? So looking at it to GDP, because obviously our GDP is growing. So that's kind of like your inflation adjustment, but more than inflation. And you can kind of see we're at 122%, higher even than after World War II, after we almost fought off the whole world and so we're in a tough spot, right? Net debt minuses out the debt that we hold ourselves, or so like maybe what we owe to Social Security, or we've taken and used that money and replaced it with IOUs like you've read about. Okay. And this, for now, it's not too egregious in terms of the pain that we feel. But when you look just over the next 5 to 15 years, the amount of what we're going to have to spend on interest, and we already can't live within our means, is going to over double, in terms of the interest expense that we have to pay on that. And so we're not going to run interest rates down and refinance our long-term debt at low interest rates. I mean, who's going to take that deal? The rest of the world is not. And so a lot of people that think that's going to happen, at a certain point, we're either going to have to raise more revenues or we're going to have to cut spending hugely. Either is going to be no fun. And so here you can kind of see beyond the fact, like we were showing you up here, in terms of all the tax cuts that have happened. The more recent thing that has happened is that, let's say, since the 80s or so, yes, they lowered the taxes, but the top rate was way lower. And even if you adjust that for inflation, maybe it's $300 and some $1,000. So we've actually doubled how much you can make before you hit that top rate as well, too. Okay. So the cuts are more than what it looks like as well. Okay. So in terms of how much you make before you hit those higher brackets, and we'll go over that so that you can see it in there as well. And then where are we actually raising revenue from? Okay. And so when you look at this, it's like, yes, individual taxes are the main. Corporate is pretty good, but it is just slim down, to get into like next to nothing these days. And we're probably going to cut it again in the next tax breaks down to 15%. Social Security, yes, that is a great source of revenue, but this is supposed to be money for you to pay out. So it's not necessarily for us. We're supposed to be able to be like what we're living on. And of course, when we look at excise taxes and other taxes, which include tariffs, it's next to nothing as well. And even if you doubled or tripled that, it's a drop in the bucket compared to what we collect. And if we had to collect more, where it would come from. And so here, as I alluded to, looking at individual rates versus corporate rates, and of course, they're about to drop down to below half of the individual rate as well, too, more than likely. Okay, so now you kind of understand, where this income tax comes from. I think it's the main tax that most people are concerned about. When we go through all the case studies and stuff that I'm going to show you, it's the main thing that we're concerned with right now, because it is the main thing people are paying, and it's top of mind, and probably why you're here. Okay, so another tax that may be in the future, well, it is now, but maybe in the future, is we look at like how much wealth inequality has gone up and how much private wealth there is just in the top 10%. It's huge. I mean, it's worse than just about any time in history that you've looked at. And so the United States does have a ton of wealth. We don't have to have a debt, even without really hurting our super wealthy people. But if you look, this was our nice way of having like a wealth tax. It was the estate tax, or the death tax, as you may know it. And, back in the day, if you had more than almost around $1 million, then you were going to get taxed on anything above that at about 55% when you die. So, that thing was, we're not going to take your money that you've worked hard or built up or whatever. But after you die, part of that was there thanks to the fact that you won the birth lottery and you were here, and we needed to run the government and help other people have that. We've pretty much taken that away. So we've lowered it down almost a third, and you're allowed to pass, and this is for each spouse, upwards of about 14 million now apiece. So 28 million can pretty much pass tax-free. And so eventually something like this is going to have to come back. So, we'll talk about that a little bit at the end as well too, if we have time, because when you're talking about tax planning, you got to think about all these things. And again, I'm not trying to politicize this or whatso. I'm just trying to help you think about it, because you can plan and you can hedge your bets, etc. And it's important to just understand where things are coming from. I did make this available to you in the files section, so that if you want to check it out or look at it later, you absolutely can. So let's move on. And so one of the softwares I'm going to show you is one that we use called Holistiplan. Okay, and it does these great, even if it's just a synopsis. And I think we're getting ready to, in the next month, launch a very reasonably cost, like one-time tax planning thing. So you don't even have to be a client, and we can do analysis for you. But when we look at this, we can just kind of either through our good OCR AI type thing, just take your uploaded tax return and break it down and make a report out of it, and do analysis for you. Or we have another service called TaxStatus. That's more for our ongoing clients, where they give us limited power of attorney to the IRS. So we don't even need tax returns. We're just tapped into the IRS and have all the data all the time. And so you can see here, when we're looking at this, we can kind of break down, in this, kind of John Doe type client. This is for a younger person that's not married. He's buying singly, made $230,000, so doing pretty good. And how much tax he paid. This was for 24, so probably just got done with taxes like many of you. How they're filing, what the marginal versus the average rate is, which if we look at that, where do I have that here? Yeah, right here. Then you can kind of see, a lot of people say, well, I'm in the 24% tax bracket. I pay 24%. Like, no, you don't. That's any money over 100,500 that you make. Yes, you're paying 24%. But the way that it works is for the first, 16,550, you paid 10. So 1,655. And then for that next, like 47, almost 47,000, you paid 12. And then for that next, again, almost 47, or 37 at this point, then you paid 22. And then if you made above that, on the actual taxable income, then you paid 24. But in this case, it was 80,985, 24%. And when you add all those together, that comes up to the total tax. And so that average rate is saying, on average, how much are you paying when you blend those together? The marginal is just saying, which one are you hitting up to, right? So hopefully I helped your vocabulary a little bit about you understanding the taxes. And again, we do analysis for people. We help them understand these things. And then we can see, where's our money coming from, in terms of earned income or business income or W-2 or 1099, was it short or long-term gains? Do we have any, losses from the past that we can use in the future? And then a breakdown, so in this instance, you could see, this person was $35,000 of their taxes was their income tax on their ordinary income, and then $2,500 and some change was like their capital gains and paying on their dividends. And then since they made over a certain amount, they had this net investment income tax, extra 3.8%. On investments and whatso. And then this person has a little bit of self-employment income, which we'll see later, we'll dig into. And so that is paying like Social Security and Medicare on that, which if you're mainly self-employed, you already know that ends up being a bigger bite here. And so we're not going to hit all through this yet. We'll hit different points of it when we talk about some of the different strategies. I just wanted to get you a little bit better understanding, like I said, of how the brackets work. And then again, just kind of a nice synopsis of when you do your taxes, how to think about it a little bit. So again, throw your questions in here if you have them. I will try to hit them as we go. So I'm going to give you, we're going to start off with some simple ones. And so one of the scenarios that I want to look at is just what happens if we save more pre-tax, right? And if we save more pre-tax, like say in your 401k or your 403b, or if you have deferred comp, you can control up to a certain amount. If you're below 50, 23,500 per year, you could control how much of a deduction you get, right? And so what I did is take his actual tax return from 24 and just copy it into 25. We said that the tax laws are not going to sunset in 2026 with how the legislature and government is right now. That's almost a foregone conclusion. There'll probably even be more tax breaks. However, if you don't make more than, let's just say, around $400,000, you're probably not going to get much of a break. Okay. And so I'm not going to go over every line in here. You'll see more of them as we go through different scenarios. But this is how this person's income is broken down between what they're making on their W-2. And inside of here, we can do different things. Okay. And so let's say that this person's health insurance is costing them about, $10,000 per year because they've got a good plan inside of there, and they're saving $10,000 per year. Okay. So if we were to do that, then, kind of their pre-tax savings, and I could split it up between here and here. It's not going to make much difference though. And then you could change withholdings or whatso, but that's kind of semantics. So if we look at this now and we come down to the bottom, okay, then we could see the tax for this person in 2025, it's adjusted for all the new tax rates and everything, if nothing else changed in their life. Okay, so I kind of used everything from last year, that they still had their business and the same deductions and interest from their mortgage, that they were giving a little bit to charity, that they would still have the same capital gains. We're just changing their income a little bit. They're going to pay, almost $41,000 in taxes. And if you take out what they put in from their salary into Social Security, that's an additional almost $14,000. Okay. So if we come up here and say, all right, let's max out. Let's max out here the 401k, right? And this is so easy. You can just log on to your Fidelity or, whatever your portal is. Some people have your interest sites for your employer or whatso, and just change your deduction on your 401k. Okay. And so we look now, we change it from about 41 down to 36, right? So that just saved straight up right there about $5,000 in taxes. Also lowered, the FICA as well too. So significant cost savings. That's really easy. This is a very common thing. I would say one of the most common things that people do tax planning wise is let's increase our pre-tax savings and get a deduction. And this very much works well when your taxes are higher now than they will be in retirement. Okay. So the next scenario I want to show you here is saving pre-tax versus saving Roth. Okay. And so pre-tax is just like what we were talking about. You put it in there, you get a tax deduction, your taxes are lower, and your W-2 will be lower. So that input for doing your taxes will be lower. You're going to have a lower AGI and thus lower taxes, okay, which could cascade into other things. We'll have another, I'll show you another one later on for a business owner, if they do a SEP contribution, and how much they can put into there and how much it helps them. When you do Roth, you don't get a tax deduction. You save the money in the same 401k, it shows up on your W-2, you pay your taxes on it, and then in the future, as long as you follow the rules, it's got to be open for more than 5 years, and when you withdraw it, you have to be over 59 and a half. You follow those rules, then no matter how much it grows to you, to keep all of it 100% tax-free, okay? So that's what we're talking about when we talk about pre-tax or Roth. In this scenario, I just put in there, person's making $150,000 a year, save 15%. They're doing it in a pre-tax 401k. We're going to say they grow at 8% per year. They save for 20 years. They're going to save up a little over $1 million. Okay. And so when we look at that, over that 25-year period, if they're withdrawing 6% per year, they're going to take out all this money, but they still owe tax, right? They got a tax deduction up here. So when you take it out, you got to pay tax. I assumed going in and going out was 22% tax. Then they're going to net out about $1,230. Okay. If we look at the same thing on a Roth, they're going to say that same 22.5 in there. Now here's the crux though. You're going to pay, about $5,000 higher on taxes. Okay. That totally jives kind of what we were looking over here, right? And so when we grow, we're still going to end up with the same amount of money, but we did save about $100,000 more, right? 5,000 times 20. You are saving more money. And even if you want to present value a bag, maybe it's worth $200,000 to you present value. Okay. So maybe it costs you about $200,000 more into, today versus, future. But you still have that same amount of money, right? That this person had up there, but there's no taxes due. It's all tax free. Okay. And you're going to take the same amount of 63,000, except all of it goes in your pocket. Government gets none. And so you actually netted out about 577,000, or about 300, almost 350, or 300 and 300, yeah, almost $350,000 more. Okay. Now that's not the end of the story as well, because if you're withdrawing 6%, and you don't know what it will exactly happen with your luck of what happens over your 45 years, it's happening with, we call it sequence of returns. But I mean, in this, we're just doing an average. There's money left over at the end. And if there's money left over at the end, even after you took out all this money, gave the government their part, use this to live, there's still a little over $1.7 million left in that pre-tax account. And when you pass, let's say you had 3 kids, they're each going to get a little over $500,000 that they're going to owe tax on as well too. Okay. Depending on what their tax bracket is. And unfortunately, about half of them do take big lump sum withdrawals. And so the tax burden on this can be quite substantial, because if they take big lump sum withdrawals, they may be only paying 15% tax. But if they took a $300,000 withdrawal to buy a car and pay off this debt and buy a house, then that may bump them up to the highest tax bracket at that point, which may be 40-some%, right? So they're going to pay 3 times higher tax than they would normally if they drew it out kind of slow and steady like you were. So when we look here, you're still going to have, that amount of money left over, because both of them are tax deferred, but the Roth is tax free. So you just made a much better inheritance for the next generation as well too. Obviously, you can spend it for yourself, but I like to tell the story because so many accountants and so many people are just hardcore, pre-tax. How can I get a tax deduction now? That they're not thinking that, when we think about tax planning is how can we pay the least amount of taxes over our entire lifetime? Or if you want to be awesome about it, like you're talking about back here, how can we pay the least taxes over even a longer period of time than that? Okay. So again, if you want to throw your questions in there, go for it. I will try to hit them as we go. I'm going to go to this next scenario. This one's called backdoor Roth IRA. And so after you make over a certain amount of money, about a couple $100,000 a year, then you're going to be ineligible to make Roth IRA contributions. Okay. But anyone can make a non-deductible IRA contribution, which you can then convert into a Roth. The crux of this, and again, you should have an advisor or some kind of tax consultant or, whatso, because they're multiple pitfalls to this if you do it incorrectly. You got to be careful that you don't have other traditional pre-tax IRAs out there, because you just can't convert the non-deductible one and not the pre-tax one. And there are ways around this. But again, I don't want to get out of the scope of trying to go over multiple different tax planning things with you and get too much into the weeds on these. So you can put in $7,000 a year, if you're under 50, and let's say that someone did that for 20 years, again, grew at 8%, then they're going to have $346,705 in a tax-free account, implementing that very disciplined over 20 years. Now, the alternative to that is, I'm not doing that, but I still got the money to save. Let me just put it in a brokerage investment account, a Robinhood, or wherever, put $7,000 in, because we want to compare apples to apples. Still going to grow at 8%. Turnover means that when you trade some of the things or rebalance or whatever with your investments, that sometimes on average, you're going to realize some gain over time. So we said about an average, 12.5% turnover, where you're recognizing some of the capital gains from that 8% growth. Okay. And then we're just going to assume that they never raise capital gains rates, which I think it's reasonable to assume that eventually they will. Doesn't look like we're in any danger of that anytime soon. But again, we're going to make the more conservative, I guess this would be aggressive in terms of tax, so assuming you're going to pay less tax. Okay. So after you pay the government the tax on the money that you grow every year, right, then it would accumulate to $313,950. Okay. And so you can see there, it's about a 10% difference, a little over. Just having the discipline to pull this little maneuver off, which, even though there's all those nuances that I talked about, it's not that hard. Okay. And the thing beyond that, okay, is that $173,000 of this account is capital gain, right? Inside of a Roth IRA, you may still have the same thing, but again, as long as you follow the rules, you get to keep everything tax-free. So even after you've paid all the taxes on that, you still owe about $26,000 more taxes if you wanted to take it out, assuming that it's still only 15% tax at that time. So again, this is in the whole scheme of things, a good 20% boost to practicing this maneuver over time in tax savings to you for the same amount of money. Okay. So we'll keep driving on. The next one that we're going to look at is, let's see, using 0% on your capital gains. Okay. And so what I wanted to show you here, and I can make different scenarios. I could add another one here, if we wanted to think about, like, for example, you're a veterinarian working in corporate or, private equity driven firm, and you go out and start your own mom and pop shop, right? So then instead of being like a W-2 employee that maybe gets some stock, hopefully, then you're going to go start your own business. And so that's kind of what happened here for this person. You can see their W-2 went away. And then, I said maybe they had to use some of their money to start their business and so they're not going to make as much off of it. In this, we can manipulate this however we want. In this circumstance, we might come down to saying, the whole first year, they made $200,000 gross, but after they paid everyone and all their expenses and their startup expenses and everything, they only really made $55,000. Had some health insurance, obviously, probably did the bronze, high deductible, and not much profit here. Now, again, that's what happens when you start a business, right? You sometimes have to lower as you're investing in and you have expenses to build up that revenue and that client base. And so you can see here, there's not no taxes, but the only reason it's like that is not because they're paying tax per se. It's because of the self-employment tax. Where are we here? Oh, there it is. Okay. That is one tax that it will drill you as a small business owner, because most people are not used to it. So when you own your own business, you have to pay Social Security and Medicare. you have to pay your side, that's 6.2 and, you know, 1 some percent. So it almost comes out to 15 total when you pay your side and the employer side. So it's like double. Okay. So you can't really get out of that one. Okay. So in this circumstance, you can see that's the only tax that's due for this person right here is only the self-employment tax. So there's no, I have this person in Ohio. So there's no Ohio income tax. There's no federal income tax. This person's only paying their FICA tax basically, which when you're self-employed, they call self-employment tax. Okay. So when we look at this, I'm going to show you a different graph. Okay. This one's showing you, let me make this smaller. Yeah, I can go up that high. I'll need this one to go that high though. So again, I'm trying to do everything live here so that you guys can see everything. Let's try that. I want it to be bigger. Okay. So what you could see here, let me make it bigger as well. What you could see is just like we talked about before, at a certain point, you're not paying any tax, okay? Until we hit up here, you know, around the 30,000 mark, okay? And when we look at capital gain, because this is all the regular income taxes and the different credits you can get, and you can look at the capital gains, you know, this person can make up to 91,000 before they're going to even pay capital gains. So if that person was making $50,000 or what so, then we might be able to realize about 40,000 of capital gains without paying any tax, like zero. So let's say, you know, in that situation, this John Doe had a good investment in Apple that he put, you know, 20,000 into, and it had grown to like 140. Well, he could sell some of his most appreciated stock to help start the business. And if this was his situation in that first year right there, there would be zero tax on that. So we could add that capital gain into here. Let's see, where were we? Into here. Let's say it was 50,000. And not increase his taxes any. It's wild, right? So that is a great planning opportunity whenever you have things happen in your life, even though it may be a good thing to start a business, make 200 and some $1,000, even though you only netted out maybe 50K of it. That's a great start to a business. But there's some impressive tax planning things you could do here, depending on what the other situations are in your life. Okay. So again, if you have questions, feel free to ask them. Some of this is kind of complicated. I hope that I'm explaining it well for you and these graphs help. But this just shows you as your income goes up, what happens. So you can see that 15% kicking in, and then refundable, non-refundable credits offsetting the refundable credits. But really for most people, and this is the single scale, until you hit about this 176,000, you're not going to pay the extra taxes, like I was talking about, that net investment tax, and losing some of the refundable child tax credit. And then on the income, say the person did not have a lot of appreciated stock, but they're in a really low tax bracket right now. We're paying 10%. If that bet practice is successful, I mean, that person within a few years could be way up here at the 24 or even higher to 32. And they were obviously saving into their retirement. So we might want to use some of this tax bracket, maybe use all of the 12% to do a Roth conversion. So you can convert what was in your pre-tax 401k to Roth. And let's just say, we want to do it all the way to the end right here. We might need to convert 107,000. I mean, we can hit that very surgically, and you only pay 12% tax on it. Still 12% on that, you're still going to owe, 12,000 some dollars on that. But again, if you're relatively younger, say you're 45, you're not going to retire until 65, and you grow that at 8%, that $100 and some thousand, can turn into, just like we were seeing with the savings and what's so, could turn into, since it was all lump sum at the beginning and not saving over time, could turn into over $500,000. And you get to keep that whole extra $400,000 100% tax free. So that's terrific, right? And a lot of people don't think about these things. They're like, well, I'm starting my business. I didn't make a bunch. Why would I spend more? Like, oh man, what an opportunity that if you'd known about it earlier, or you don't know about it and you figure it out later, you're just like, oh my gosh, I should have done this, right? And they're huge for you. Okay, so let me see. Question wise, looks like we got one here. It says, say I have substantial income and I want to contribute more than the max to the 401k contribution. What is a good way to save more money in a qualified accounts to save on taxes down the road? This is a can of worms. Obviously, it's different for different people. So if you're maxing out your 401k, sometimes companies have what's called deferred compensation. Depends. That one they're allowed to discriminate on, so they offer it to certain groups of people and not others. You have to see if it's included in yours. Generally going to be for-profit places that do that. Nonprofits sometimes have something instead of non-qualified deferred compensation, they have qualified deferred compensation. So if you work for like a state hospital or university or a K through 12, you have this qualified deferred compensation that you can do with your 403b, because nonprofits have 403bs instead of 401ks. So you actually have these two plans inside of there. Inside of 401ks, sometimes they'll let you make after-tax contributions, which can go up to like 60,000. So anything above that 23.5, you would be allowed to put in extra after tax. And additionally, what you would want is in those plans that allow after tax, a lot of times they'll let you do in-plan Roth conversions. And so that's that. If you've ever heard the term mega backdoor Roth, it is that concept. Okay, so those are a few ways. I'm not going to get too much into the weeds on them because we could talk a lot about each of those as well too. But good question. Now that all begs the question that you have the cash flow to do that, and don't forget about your spouse. I've had multiple times where I've met with one spouse, it's a doctor or some other high earner, and the other spouse, maybe is a teacher or an admin, and they're like, I'm maxing out everything we can do, all these benefits, blah, blah, blah. And I'm like, well, what about your husband or your wife's 403b? And they're like, what are you talking about? I'm like, you can do another 23,500 over here. And they're like, oh my God, that's huge. It's like, and they like totally ignored it. Don't forget your spouse's plans if you're married as well too, because that's a huge one. Okay. And then looking at some of the other things that you can do. Where are we on time? We're getting up there. I'm going to skip because some of the easy ones you can do are like credits and what's so. And so like the refundable credits that you have down here, we can look at these and you can, when you look at like how much for like child tax credit, right? And so if you make a lot of money, you could be phasing out of that. And so not only like we did that first scenario of like reducing your income by increasing your contribution, you may not be doing that because you need the cash flow for something else, or you're just like, we have to save $4,000 a month because we're saving for this house, but you may be barely phasing out of the child tax credit. And if you made $5,000 to $10,000 a year contribution to your 401k higher, you would get in, right? And beyond the tax savings of that deduction, you're allowing a credit to come in. Okay, so that is like a huge thing, right? Other credits as well. Where are my non-refundable credits in here? There we go. As well would be like the energy credits, right? And so, if you're getting new windows or door, you can get 600 off there. You get a heat pump, it's like 3,000. If you're getting solar panels, hopefully it doesn't go away, but you can get 30%. Like, it's huge. I mean, I think you have to be careful there because there's a lot of installers and contractors to me that are not like doing right. They're overcharging just because they're stealing people's credits. Basically, they're like, I know this is unaffordable, but once you get 30%, it makes it more affordable. And it's like, no, you should do what it costs that you make a good margin on as a business to do this, and the credits are for the residential owners. So you got to get a good installer, in my opinion, or like I've done it in the past and I'm going to do it again. You can install your own, right? And that's huge. I mean, that makes the return on investment very fast. For me, I installed mine, and then I ended up getting an electric car, and I was mining crypto with the extra energy. In addition to saving all the utility costs, no gasoline, my return on investment was probably like 3 years. It's crazy, like how good of an investment some of these things can be when you combine it with the tax planning that you have available, especially if you're paying at a higher tax rate as well too. So those two I was going to model out and show you more, but I'm not going to have time to actually do it. I just want to give you the concept of it. Business owner. Again, I'm going to give you a concept on this one. A lot of people will get a business car, right? Or you're using it for business. I mean, heck, this one's been around for a long time. I remember when I was younger, my dad had an optometry practice, and they bought heavier SUVs as like company cars, and you get the accelerated depreciation on that, which if you're in high earning years, can absolutely be a boon to get an extra $10,000 deduction or what so on a vehicle that you were going to buy anyways, but nobody just told you if you bought one that was 6,000 pounds instead of 5,500 pounds that you get that bigger tax benefit out of it. Okay. So that's another good one as well. And then this one I'm going to model out. Okay. So now we're going to do business owner. So business owner John Doe here. And again, we're going to start saying that he has a better year now. Okay. And so we're going to say, kind of taking it back to where we were, making over $500,000 for the practice and maybe netting out, 250 and some change. Okay. After all the expenses and employees are paid and everything. Okay. So now it's going to be a lot more in taxes, as you can see there. And that was showing 58,000. And we got to get in here to, there's so many different things that I can do here. That's why I said it's live. Bear with me in terms of I need the self-employment. Hang on. Hold on. We're going to get there. There we go. Oh, I already put it in here. Okay. So let me take this. Let's just say this is the first year that he really did well in the business. Okay. We're going to go back to this range calc thing here. Let her load up here. I just want to make sure it's going to go back far enough. And if we look at this, then you can see here, there's a huge amount of tax being lost right here from them not getting the qualified business income deduction. Okay. So if you make over a certain amount of money, then they're not going to let you get this big deduction for owning a business. And so if we look here, how much we'd have to contribute to get this, probably, right around 36,000. So I'm just going to go back there and give them a $40,000 deduction. So right now, when we look at the taxes, a lot of people fall into this trap. They're just like, they do everything they can. They did all their bookkeeping well. They've got all their business expenses in there. But this person's going to owe $77,641 from, making a good living there. But let's just see what happens. If, I had to go back to where we wanted the self-employment, self-plans. So you could have this as a SEP, IRA, or a solo 401k. But if you're a solo practitioner, we just had somebody in a similar situation just this year. You're absolutely allowed to put in 40,000. It could go all the way up to that, around that 60 that we were talking about. Okay, and so we plug that into there, and it's going to save them double whammy. It's going to save them about $18,000 in taxes. Okay, from making that 40,000. So almost 50% of what you put into there is paid for just by the taxes. So what an amazing impact just from that one thing. And that's so easy. We can usually get this set up for someone to be able to do in like a day. Okay. And so, and you're allowed to make this after the year is over, at least the employer contribution side of it. And so that's a huge one for tax planning that has immediate payoff, really big, fast there. And even though we said taxes may be higher in the future, if you're paying, like on those dollars, almost 50%, right? Like it may be a decent bet in the future, especially if you're saving some Roth and you do strategic Roth conversions over your life, that you can keep it at under 50 in the future. Okay. And so that is a powerful pre-tax tax planning thing right there. So again, throw your questions in there. I'm going to keep going over a couple more things. I'm going to switch clients now to one that I call experienced John and Jane Doe. They're married, they're 67 and 70, right at retiring. I know a little bit later, but we have a lot of clients that do that. And you can kind of see last year when they filed their taxes, they're working, the husband's phasing out, so they're only going to work a half year. They're going to withdraw a little bit more from their, retirement accounts. They're kicking in their Social Security, start paying out, etc. And so they're a little bit different than the younger John Doe. And they do have some business income because Jane in this one is doing like a little Pilates studio or what so. And so they have some earned income as well. So if we were to look at their tax report, then you can see theirs looks different. Okay, so their ordinary tax, they still have self-employment tax because Jane is doing her own little studio. And then they have a little bit more investment income coming in. So they're paying a little bit more tax on their capital gains and what so. And another thing you have to look at as you get past 65, if you're in Medicare, is that the more money you make, then it makes the premiums for your Medicare go up, right? And so, if you're under 212,000 as a couple, then you just pay regular plus 185. So you probably heard a lot of people say, yeah, it's 185. I mean, just a few years ago, it was 160. So that is that thing that you pay for Medicare Part B, you get your Part A for free since you did your 10 years, but you start making more money, it is means tested. Another name for this is called IRMA. And so it's income related Medicare adjustment. And so you can see it can go up. I mean, if you're doing well, I mean, it can change your premium, from 185 to like 530. And that's each. It's for each spouse. So that's $1,000 a month for John and Jane together, right? So we watch this as well too. A lot of people do have problems with that if you've done well, saved well, especially if you stacked on a lot of pre-tax inside of there. Whenever we're doing these reports and stuff, again, there's a lot of things we can glean and do in scenarios with people, but we put a lot of observations and insights so that you or they can think about the things that are happening as well too. And then depends on the state, but most states we got in terms of some state tax hints and observations and things that you might be able to tune up on as well. So one of the things I wanted to show you here is when we do planning for clients, one of the big things that helps a lot are Roth conversions. Okay, because at a certain point, if we look at the future, because this is just doing all the years, kind of down through their retirement, and this one goes back a little bit farther, but you can kind of see, when they retire, their taxes are going to go down. And then at a certain point, the government makes you take out money. Okay, it's called required minimum distributions. For most of you on here, if you're not close to it already, it's going to be 75 for you. And so you're going to see probably a familiar thing. If you're making money now, you're paying a lot of taxes. Okay, and then the taxes are going to go down. A lot of people are like, whoopee, This is a great thing. I've paid taxes for a long time now. It's great that my taxes are going to go down. But then what ends up happening is you get slammed and they go higher than ever. And that's if we ignore all that deficit spending and debt, the taxes could be higher. This is assuming that the current tax cuts stay in place and continue forward without any changes, right? So low tax regime, and it's going to be higher than ever, right? And so wasting these low tax bracket years is probably, nobody knows the future, but probably a big mistake that a lot of people, temptation that people fall into to want to pay that low average rate right there, right? So I'm going to show you, let's see, we got one more question here. It says, I anticipate a large income year in the near future that will push me into a higher tax bracket. I have a good amount of appreciated stock and crypto that I am also worried about selling. Is there anything I can do to reduce my taxes? Yeah, there's lots of things you could do. Obviously, it depends on how you think about the future and what you're willing to do, et cetera. Because, one of the main things that you can do if you're charitably inclined is to, and I'm going to hit this right after this if we have time, do a donor advised fund that you're allowed to donate securities to. So then that way you wouldn't have to pay any of the capital gains or the appreciation on those things, and you would get a tax deduction for what the value of them are. So you could donate enough of that to get a big deduction to offset all the rest of them, and then you could sell. But again, you have to be charitably inclined to even do that because you're giving away money, right? But if you were going to do that anyways in a donor advised fund, then you can give it out over multiple years. So it's like, I was going to get $5,000 a year anyways. Well, let me put 10 years worth of in there. And the next 10 years, I'll just give out of that fund, and you could stack all those deductions in 1 year. It's a pretty cool strategy. That's probably the most efficient. But again, it doesn't work if you weren't going to give money away anyways. Another way is, when people are thinking about the future, they're like, well, my capital gains are 15%. When I hit these higher years, it's going to bump me up into, 20 or so. And I think in the future, they're going to change it into normal income tax rates, which I'm generally at 24. So you might want to accelerate now. Well, if you got, 3 years to go until your high income starts hitting in, because maybe you're doing your tenure into something to where you jump up like a residency or something like that, then maybe you split it over 3 years. There are things you can do to sell some of your losers in your portfolios and buy equivalent other things to where you can tax loss harvest to offset some of the gains that you have. And if you've got multiple years to implement, then that helps. You could have your spouse put more into their retirement plan and you sell more of these stocks, and then those things kind of offset each other. There are lots of things, and you have to kind of play around. That's powerful. We could do lots of different scenarios and put the different permutations into there to where it actually works for your life, that the cash flow works, that you get the actual result that you want to. And then, like I was showing you here, that we're balancing looking at the whole long-term picture and not just thinking about the short term. It's so easy to only think about this year and next year, and we're not even thinking about this. Or like, let's say we're here to rejoice at this and not see the looming burden coming, and that's even like optimistic right there. And so you can kind of, this is our financial planning software. It's very complicated in terms of we've got all their investments inside of there pre-programmed in, all the tax rates, all the different things that happen, and then we program in these different levers where we can do what ifs. And so in this one, there is a Roth conversion, to do Roth conversions during that lower tax period time, and you could see, if they live to 100, obviously that's doing the whole thing, it increased what they have without any difference in spending or anything like that, just tax arbitrage by about 600,000. And I've already backed out inflation. It'd be more if I wasn't minusing inflation out of there already. So more than $500,000 improvement from doing these things inside of there. And so you can visualize what that looks like. You can see here, all we did is accelerate some taxation. Not even as much as we could, to just get it to level out. Because if we accelerate some more taxation here, then it's lowering it for all these years because there's less in there. This is their oh, I thought I threw their balance sheet up here. Oh yeah, there it is. It's lowering. If you look at this pie chart, it's saying what do they have in non-retirement assets like a brokerage account? What do they have in their pre-tax account? What do they have in their Roth IRAs, annuities, and in their house or rentals or whatever? And so for most people, this pre-tax blue one, oh, it just ends up being huge. I mean, 50 to 80% of what most people have, unless you're pretty wealthy. Once you go over a net worth of like $3 or $4 million, it does change to where taxable and real estate tends to be bigger. But for most mortal Americans that are saving well through their retirement plans, this blue one right here ends up being really big. And the bigger that is, the more your problem is going to be with these RMDs later. Okay, where you want to save that Roth stuff, you want to figure out strategically when you can do Roth conversions, and then we can run all kinds of different things for you in terms of like, let's see here. So they're retiring here. Their taxes are going to go down. Then next year it's going to be even more. But we can actually program the Roths into here. And this would just do like 1 year, right? Well, I don't want to override the whole thing. We'll say he does it because he's older. Usually we like the older person to do the Roth. And we can do like things like this to show people, and we can fill out here to put all the extra information into there from like the non-retirement accounts and income and Social Security and different things like that, so that it gives you a better projection. Right now, actually, let's see here. I go back to, I think I might have already done it. Yeah. Then you can kind of see here, this one's doing a 60K Roth conversion until John hits 75, and then 30K for a couple more years before Jane does. And so you can see they pay more taxes, right? Because they're doing those conversions, but then afterwards they pay less forever, you know, because they did those conversions earlier. And here you can kind of see their tax brackets, that dark blue being how much we lowered it. And then the colored lines are just the different tax brackets if you hit them and don't. So you can see this, it keeps them under this 32% one by doing it inside of there. And then this just shows where they saved on IRMA as well too. So it's not a fix all everything. You know, I call this one mega Roth conversion. And let's say they ended up doing, you know, a 600,000 conversion just one time, 1 year. And this works really well because it'll pop them into IRMA once and then leave them lower for a long time after. But again, this couple has pension income and good Social Security income, but you can see what it's doing to IRMA here. It's almost making it go away. It does come back eventually because they're growing their money good. And you can see, whoa, it's hard pill for someone to swallow to pay $200,000 in taxes, but then you can see all these tax savings, you know, down here, which is huge. And you can see from doing that 600,000, when we just look at the total tax paid over their entire lifetime, it saves them like $550,000 in taxes in present value. So that's already adjusting for inflation. So that's huge. And a lot of people don't feel empowered that they have the information to be able to make decisions like this. So tax planning is very important. There were some more things that I wanted to go over and show you, but we're going to have to wrap it up because we respect your time. I hope you enjoyed this. I hope it helped you. We do stuff like this all the time for our clients. There are lots of other talented, good professionals that do as well. As I've mentioned lots of times in the past, I mean, follow us. I mean, I make awesome presentations like this every time to where they're very practical. Nobody else is doing exactly what I'm doing because I make these usually the week before so that they're very timely as well too. Join us for learning more. We even have a free level of joining our firm now. It's called Freemium. And then we have a Freemium Plus if you want us to manage something. If you're just not ready for an advisor, but you want to be a part of our firm and use a lot of the tools, you can do that. And then, of course, you can come to our advisory type things. Check out our website, rftax.com. That's all about our tax planning and preparation. We do taxes for most of our clients that are our advisory clients. And then, of course, just check out our rebelfinancial.com and keep joining us for the future. If you have questions, you're watching this on the recording, put in the questions. They come to me. I'll answer them to you in like a video like recording format. You'll get like a 1 to 2 minute answer. I like doing that for people that'll interact and be curious, and hopefully I help you. And we think we can change the world by helping enough people. We hope we have the opportunity to help you. Have a great rest of the week. Thanks for joining us. We hope to see you next time. See you then. Bye-bye.